This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So following on from our chapter on non-current assets with property, plant and equipment, we're now going to go through and look at another accounting standard, which is all about borrowing costs, and that's covered by IAS 23. Essentially, borrowing costs advances what we saw in the last chapter, whereby we looked at the cost that we capitalise as part of directly attributable costs to constructing or buying the asset, didn't we? So what we've got now is to look at another, if you like, directly attributable cost. And the standard refers to it as a borrowing cost. To you and I, essentially, it's interest on a loan. That's it. You know, if you go through and are constructing an asset, that asset will take a substantial period of time to get ready in order to be able to be used within the business. And therefore, what you may do is you may take out a loan. If you go through and take out a loan to fund the construction of that asset, then you will pay interest on that loan. The benchmark treatment when you take out a loan is that it gets expensed to the statement of profit or loss. That interest cost that you incur goes straight through profit or loss. However, we have some specific rules here that say, well, look, as that interest is a directly attributable cost of the loan, which was then used to help fund construct the asset, then what you can do is that under strict circumstances, you can go through there, and instead of expensing the interest through profit or loss, you will go through there and capitalize it as part of your item of property, plant and equipment. Now, what that is doing, therefore, is it's not taking that expense to profit or loss. So it's not reducing profits, but it is increasing your non-current assets, isn't it? So it's not necessarily prudent to start increasing the value of your asset. So in order to be able to capitalize the interest, you have to meet strict criteria. So as well as being able to go through and calculate the amounts that we are going to capitalize, you will also need to go through as well and think about when we start capitalizing, when we stop capitalizing, and is there a period in between whereby no construction is taking place and therefore we begin to suspend the capitalization. So I think that there's two distinct areas that we need to look at. So just to recap, it's looking at the rules about when capitalization starts, stops, and is suspended, and then also thinking about the numbers that we calculate with regards to the capitalization of the interest. Okay, so let's go through and have a look at the notes in a little bit more detail. And the first bit focuses, if you like, on the rules. Okay, so we refer to it as interest. The standard goes through there and talks about it as borrowing costs, but borrowing costs essentially is any interest that you incur on a loan. Okay, don't worry about the next little bit where it talks about net of income received from the investment of the money borrowed. We'll come back and talk about that a little bit later on. Borrowing costs apply on a qualifying asset. So a qualifying asset is essentially an asset that takes a substantial period of time to go through there and construct. Okay, there's no definitions about what a substantial period of time is. That could be 3 months, 6 months, 9 months, 12 months, 2 years, 3 years. We need to be able to look at when the interest can be capitalized, when it can be stopped, and when it's suspended in between. Okay, so first bit we're going to go through and look at is when capitalization starts. And again, we said we're trying to be prudent by not capitalizing too much interest. So when we're looking at when capitalization starts, it tends to be at the latest possible point because we need to go through there and meet all three criteria. So the three criteria there that we have is, the first one is that there must be expenditure being incurred on the asset. So whether that's labor or whether that's, more importantly, materials are being bought to go through there and be put in to the construction of the asset. So when there is expenditure, that's one of the three criteria that we meet. The other one, it goes without saying really, doesn't it? But the borrowing costs are being incurred. You are actually accruing interest on the loan, which, you know, goes without saying, doesn't it? You know, because if you're not accruing interest on a loan, then there's nothing to capitalize, is there? So we need to make sure that we have the expenditure. We need to make sure that there are borrowing costs, And then as well, what you have there is that the activities are in progress. So essentially, construction has actually commenced. Okay. So if you think about it in maybe like a chronological order, what normally tends to happen, and things can change within an exam question, be aware. But normally you identify a project, you take out a loan, so you've got the borrowing costs are being incurred, but you cannot then just start to capitalize them, because then you use the funds from the loan to incur the expenditure. So maybe you buy the materials, but you've then only met two criteria. It's not then until physical construction takes place that you then begin to capitalize the interest on the loan. Okay, any interest before that is just treated as normal and taken directly to the statement of profit or loss. So it tends to be that capitalization starts at the latest possible date. If we go through there and then look at when it starts, when it stops, it tends to stop at the earliest possible date. Okay, so that the capitalization must stop when the asset is ready for its use or when there is no active construction. Okay, so when you get to the end of constructing the asset, it may be ready for use, but is not physically being used. You may still be incurring interest on the loan after that point, but the asset is ready for use. If that's the case, boom, if it's ready for use, then we don't capitalize any longer. The interest goes back there to profit or loss. Likewise, you can stop or temporarily stop the capitalization of your borrowing costs if there's no active construction. So no active construction tends to take place when there is maybe some bad weather or maybe when there is a strike or industrial action. Okay, if that's the case, that there is no activities taking place to construct the asset, therefore we do not meet those three criteria, and therefore we must temporarily stop the capitalization. Okay, but then once all three criteria are met again, you've got it. Okay, we can go through there, can't we, and begin to capitalize once again. Okay, the last rule, I don't want to bore you too much with all the rules, is going through there and looking at the different types of borrowing. Most of the time what you have is you have what are referred to as specific borrowings. So specific borrowings are where you take out one loan to fund the construction of one asset. Okay, if that's the case, the standard uses the word effective rate of interest. That's only really relevant as you move on to when you get to F2. But for now, in your F1 exam, just use the rate of interest on the specific borrowings that you have taken out. So if you have a 5% loan, then go through there and use that 5% to work out how much interest you go through there and capitalize. Okay, that's looking at specific borrowings. There are some general borrowings, but we'll talk about general borrowings after we've gone through and worked this first little example that we have. Okay, so what have we got? Example number 1 talks about the specific borrowings. So specific borrowings, you're going to use the effective rate of interest to capitalize the interest on the loan. And then we need to think about when construction and activities and when borrowing costs start, so that when we meet all three criteria, we can then begin to capitalize the interest, can't we? Okay. So here the example says, calculate the amount of interest to be capitalized as part of the non-current assets. We're going to assume that it is a December year end. So what you have here, it says Columbia commenced the construction of an item of property, plant and equipment on the 1st of March 2015. So presumably before that, we were incurring expenditure, weren't we? Okay, as soon as construction commences, we are incurring expenditure, aren't we? Because we must be paying somebody to construct the asset. Okay, on that date, we also went through there as well and took out a $10 million loan. Okay, so it's specific borrowings, and the rate of interest was there at 5%. So we're going to use that 5%, aren't we, to go through there and capitalize the interest on the borrowings. So what you've got there is that for a full year, 5% of, is it 10 million is that there as $0.5 million. So that would be the amount that you would capitalize for a full 12 months. The issue that you've got, however, is that we started it, was it there on the 1st of March, wasn't it? So if you go through there, is it from the 1st of March? The 1st of March to the end of December is that as 10 months, isn't it? So I'm looking to capitalize the interest for 10 months, but do just be aware. It says there that there was a strike, therefore there was no construction that took place between the 1st of October and the 1st of November. So is that there was no construction that took place for 1 month because of a strike. So therefore we are going to temporarily suspend the capitalization for 1 month of the year. So what you've got there is, even though we have 10 months whereby the borrowing started, for 1 out of those 10 months, we weren't constructing the asset. So therefore, what we're going to do is we're going to take 9/12 of that amount, aren't we? And if you take 9/12, is it of the 0.5 million? So 9 divided by 12 times 500,000. Does that go through there and give you, is it $375,000? Okay, there we go. So the amount that will be capitalized is $375,000. Just be careful. The interest, is it there for 1 month? Is it there October? That would be expensed to profit or loss. So if you wanted, you're not asked for it within the question, but if you take 1/12 of the 0.5 million, so 1/12 of the 0.5 million is that there, I think, 41,667. That amount there will go to the statement of profit or loss, whereby our amounts capitalized as part of property, plant and equipment go to the SFP. Okay, so our question there asks for the amount to be capitalized. There's nothing, that could not happen within an exam question that just twists it on its head and says, instead of what needs to be capitalized, what should be expensed through profit or loss. So just be aware of that and have a think of it when you're there within exam questions. Okay, have a practice at some of them. I think you find the most difficult bit on this borrowing cost question is counting on your fingers, trying to work out the number of months. It always cause you difficulty. You're probably looking at the 1st of October to the 1st of November and thinking, well, October, November. No, it's all of October, and then it's just that first day there, isn't it, in November? So it's just the entire month of October, 1 month. Be careful, think about it. Just moving on before we go through and complete this small little chapter. We've then got there, is it your general borrowings? So when we go through there and look at the type of borrowings, we have your specific borrowings, whereby you take out a loan to fund an asset to be constructed. Okay, we've gone through there and looked at that in example number 1. The next example that you've got is looking at general borrowings. So that's whereby maybe you have a treasury function within the business. The treasury function has taken out several different loans and has just pooled all the loans into a pot. Okay, you need to go through there and borrow some funds from that pot. But the issue that you have is that you do not know, do you, what rate of interest relates to which portion of the loan that you've taken from that pot. Okay, you could have taken some funds from a loan that was at 4%. You could have taken some funds from a loan that was at, say, 2% or 5%. You just don't know. So the key bit that you have is that when you have your general borrowings, what you will go through and do there is that you will work out a weighted average. So work out the total amount of interest that you have on all of your loans, and then work out an average based upon the value of the loans. Okay, so let's say that again. To work out the weighted average, you're going to work out the total interest on all of the loans. And then to go through there and work it out as a percentage, you're going to have to go through there and weight it, aren't we, based upon the value of the loans. Okay, that's it. If you're still stuck, let's work the example and see how we get on. So in number 2, it says calculate the amount of interest to be capitalised as part of the non-current assets. Again, we'll assume that it is a December year end. And it says Venezuela had the following bank loans in issue during 2015. So you can see there that we have 2 loans. One is there at 4%. One is at 3%. And we have different amounts of borrowings, don't we? We have there, is it 25 million and is it $40 million worth? Okay. If I want to fund the project, there's $65 million for which I can borrow. Okay, but I'm not going to borrow all of it, am I? Okay, I might take out different parts at different points within the year. Okay, so to work out how much is capitalized, I'll need to work out the weighted average amount of interest first. Okay. But as we carry on, it says Venezuela commenced the construction of an item of property, plant and equipment on the 1st of January 2015, for which it used its existing borrowings being the 25 and the 40 million. And it says 10 million was used on the 1st of January. So is that 10 million for 12 months? And then 15 million was used on the 1st of July. So if that's the case, is that 6 months? July, August, September, October, November, December. Okay. It's difficult counting on the fingers, isn't it? Okay. So I need to work out a rate of interest that I'm going to use and apply to the 10 million for the 12 months, and a rate of interest that I'm going to apply to the 15 million. Is it there for 6 months? Okay. So what have we got? Well, if we go through there and work out the interest, so 4% on 25 million, is that there as $1 million. Okay. So 4% of 25 million. You've then got there, is it 3% of 40? Is that there as 1.2 million, isn't it? Okay. If you combine that together, the total interest that you've got is $2.2 million, isn't it? Okay. The amount of borrowings that you have in total is that $65 million, isn't it? Coming from the 25 and the 40. Okay. If you work that out on your calculator, I suppose technically you need to multiply it by 100%. That gives me 3.38%, isn't it? Okay. So a question could just ask you to work out the weighted average amount of interest on the borrowings to be used. Okay, so that's there, is it, at 3.38. However, this is a little bit more specific, isn't it? Because it wants the interest to be capitalized. So if that's the case, what we've got there is it's $10 million multiplied by 3.38% for a full year. You don't have to put in multiply by 12/12ths, but that's just me being particular. And then you need to go through there, don't we, and give consideration to the 5 million multiplied by 3.38%. Sorry, not 5, careful. 15. I can hear you all shouting at the computers there. Chris, no, it's not 5, it's 15. Multiplied by 3.38%. And don't forget the key bit there is that is 6/12. Okay, because it was from the 1st of July to the end of December. Tapping that on your calculator, I think you get, is it 0.338 million? I think there you get, is it 0.2535 million? Tap it in on your calculator, see what you get, and I think if you total it up, that should come bit of rounding here or there. Is it 0.59 million? So a little bit more challenging, isn't it, when you have to work out the weighted average interest rate on the general borrowings and then apply that within a particular scenario. Okay, I personally think that if they were to ask you the amount of interest capitalised on general borrowings, that they may give you the weighted average rate first, but you never know, because I think it's a bit unfair, isn't it? If you make a mistake on the weighted average and you can't calculate that, but then you can work out the number of months and apply your wrong figure to the correct numbers, you wouldn't get any credit. And I think that would just be a little bit unfair, wouldn't it? Okay. But there you go. It's only a small standard, is borrowing costs in IAS 23. Work through the examples, have a go, see how you get on. If you get stuck, you know where we are.